morning, and welcome to this session of the LuxFLAG Sustainable Investment Week. I'd just like to take a moment to thank you all for your support during these difficult months since the tragic passing of LuxFLAG's general manager, Sachin Bankalas. Sachin was a great human being and a tireless supporter of sustainable finance. He exemplified LuxFLAG with his passion, ambition, and drive to move to a sustainable future. Thank you once again. As chairwoman of LuxFLAG, I'm very pleased to see that after 2 editions, the LuxFLAG Sustainable Investment Week has already gained recognition, and that is thanks to LuxFLAG's associate members who are showcasing this week where they are in the sustainable finance journey. Given that we're all in different stages of that journey, this week is about sharing best practices so we all advance towards the goal of making all finance sustainable. For this 3rd edition of the LSIW, we thank you for such a positive response with 3,500 registrations for the week. Fantastic figure. And I'd like to thank our host partners and media partners. The 25 sessions over the week cover a wide variety of topics, the latest trends and most pressing issues in sustainable finance. And we hope you find inspiration in these sessions in terms of the progress being made to harness finance to find solutions to our current environmental and social challenges. Just a few housekeeping points. The slides and the recording of the sessions will be made available to you in a week or so. And for the Q&A, I think we've had some issues with the Q&A button down at the bottom right, but please put your questions in the chat. And we will aim to have, the panelists will aim to answer those questions. So questions in the chat. So I'm pleased to introduce this session hosted by Société Générale Private Banking on how to ride the energy transition wave. Thanks also to Société Générale, as the organization will plant 1 tree for each participant attending the session. A fantastic initiative. Sorry to give away this prize, but it was a great initiative, so I wanted to mention that. So I'd like to introduce now Alexandre Kegara, sorry for pronouncing your name incorrectly if I did, Managing Director and CEO at Société Générale Private Banking and Wealth Management. Alexandre, the floor is yours. Hi, Alexandre. You'll have to unmute yourself. Forgive me. Thank you.
Do you hear me? Yes, perfect. Thank you, Denise. Thank you, hello everyone. I'm very pleased to welcome you to Société Générale Banking session of LuxFLAG Sustainable Investment Week. My name is Alexandre Kegara. I am CEO of LSIW21. The group Société Générale has been engaged in energy transition since many years, and we are stepping up our engagement. This year, we have joined the Net Zero Banking Alliance as funding partners, and we have engaged ourselves to align our investment and credit portfolios with trajectories aiming at carbon neutrality by 2050, with the ambition goal of limiting global warming by 1.5 degrees Celsius. So today we are going to talk about energy transition. When talking about sustainable investments in the context of LuxFLAG, we are usually often talking about the listed instruments, equities and fixed income. So this part will be presented by Petra Besson-Fensikova, who is a portfolio manager and head of ESG at LSIW21. Also being part of a major banking group, we will happy today to go further and show you how the energy transition is also changing the landscape of financing activities and how impact and change can and need to be done in frontier markets. To deepen these thematics, I am very happy to welcome our colleagues from Société Générale Investment Bank, Marie-Aimée Bourry and Eric Bonin. Thank you for both of you to be here with us. Before leaving the floor for the presentation, I would like to thank you, all of you, for this connection that is going to be transformed into a positive action. So Société Générale Luxembourg, in collaboration with MyTree, has committed to plant a tree in your name this winter in order to restore a forest in the Vosges that has been damaged by insect attacks. So thank you very much, all of you. I hope you will enjoy this presentation. And Petra, the floor is yours. Thank you very much.
Morning, everybody. Thank you for joining our session. I will start this presentation with the urgent call for the action. Plus 67%. This is the rise of carbon emissions in just 28 years since the 90s. 67% is also the budget we have not left anymore to limit the global warming to 1.5 degrees. This summer, we had a report from IPCC, the International Panel for Climate Change, and this largest panel of scientists in the world has come to the conclusion that most of us already expected, but didn't dare to say. The climate change is almost certainly caused by human action, and the average rise of temperature is already of 1.07 degrees above the pre-industrial levels. Climate change is thus widespread, rapid, and intensifying, and some trends are now irreversible, at least during the present time frame. So in order to succeed to limit the global warming, we need to act on 3 levels: regulation, economics, and demand. And from the regulation perspective, the action, we are seeing it coming. We are seeing heightened political commitments towards net zero with specific plans of reducing the country's emissions and setting up the ambitious goals, not only towards 2050, but also towards 2030. Just this year, we have seen the US that have rejoined the Paris Agreement and set up the ambitious goals for 2030. We have seen also China, responsible for a quarter of the world's carbon emissions, that have engaged themselves to the carbon neutrality in 2060. And they have set, for example, the world's largest carbon emissions trading that has started this July. And in Europe, we can say that we are the leader in not only in the climate investments and climate engagements, but we are seing the increased regulation that is going around these climate investments. Companies that need to declare different kind of information, and investors that will need to use these information. So these political engagements will shape the regulation for the next 10 to 30 years and will, and already are, direct the important financial flows of the investments into climate action. And seeing these bold plans, carbon net zero for the state, we know today that this is reachable only if we are capable to go through a new energy transition. So since the industrial era, we have went through the main use of the coal to the use of the oil, and now we are in the need of the breakthrough on renewables, clean energy. According to the International Energy Agency, the share of renewables in the global electricity production generation needs to increase from around 20% today to 30% in 2030s and to 65% in 2040s, while decreasing the fossil fuel shares to maximum 15% in 2040. The positive thing is that with the technological progress and the scale of the cost of renewable energies that is already lower on the levelized cost of energies, this might be possible, and how to reach that will later talk my colleagues. And so we are seeing that the states are engaging themselves, and what are the companies doing? We have shown this graph already last year, where the number of the companies engaged that has set up the science-based targets towards carbon neutrality were around 1,200. Today, we are seeing that 2021 was again the year where the companies have stepped up their engagement. There are now more than 1,900, representing nearly 20% of the world market capitalization. Just on the buy side, we are talking today a lot about biodiversity. There are also the talks about setting up the science-based targets towards the biodiversity goals currently at the moment. And the companies who are seeing the huge transformation, they are pushed by all the stakeholders, not only the regulation, but also from the employees, for their shareholders. And we have seen a lot of engagement actions that have taken the place during the General Assembly that has pushed the companies to reevaluate their business models and to change their orientation and their business plans for the next 5 to 10 years. So usually, as an investor, we are talking here about the direct finance, the influencing the cost of capital of the companies by buying their shares or buying their fixed income. This money are flowing into general company that then can make the different impact on the world. What I'm very happy today, as Alexander told us, I'm having the colleagues from the investment bank that will be talking about how this money, how these companies can further finance themselves and progress towards concrete energy transition projects, or going further into those frontier markets where this energy transition is so much needed. So without, I will now pass the floor to Eric. The floor is yours.
Thank you, Petra, and thank you for this introduction word. So on my side, I wanted to comment 2 slides in practice. One is about the mega trend that is represented by energy transition. And the second one will be a sort of a focus on key topics that we believe are really draining most of the CapEx and are the keys of the equation to go to this, let's say, sustainable development goals ultimately. So just in a few words, the energy transition is, let's say, a mega trend today and has cumulative investment that are just enormous. So we can talk about different numbers depending on the different climate scenario that we are using, but in practice, just to have that in mind, if we look at the period 2019-2040, and we take the SDS 2-degree scenario, we're talking about 30 to 46 trillion to be spent over this period. What is striking for me, coming from the oil and gas industry initially, that these amounts in energy transition are representing twice the amount that will be spent over the same period of time in fossil investments. And I think that's really here a revolution that we are just entering into. Now, if we focus on the key elements where most of the CapEx will be spent during this period of time, we can see that there are 3 main ones. One is about renewable energies, and I will enter, let's keep on this one. I will enter into more details on renewable energy in a second. So yeah. Then there is another one which is about energy efficiency. Usually this one is not so much commented, but the reality that it represents more than a third of the global equation. So very key to look at it precisely and see how we can finance those type of energy efficiencies for our clients, corporates, and financial institutions. And the third one is about mobility and other, let's say, industrial use when we are talking about decarbonization. So everything which is outside of the renewable energy scope, be it hydrogen, be it credit carbon storage and utilization, and other type of topics. The second element I wanted to comment a bit is about where most of those investments will take place across the globe. So obviously, the energy transition is a topic for all countries in practice, but there are regions where there are much more investments needed than others. And in this case, APAC is really driving, let's say, the mode with around 40% of investments to be made on that front, North America 20%, and Europe 18%. I think what is important just to mention here is that local context for each individual country is very important to have in mind, as in a number of situations, most of the CapEx will be spent in energy transition, but for example, for North America, obviously, conventional fuels remains a key central piece of the CapEx to be spent during this period, having access to cheap gas and existing infrastructure. Now, talking about what are the sectors that will take place actively to this energy transition, in practice, all sectors of the economy are just entering into a decarbonization strategy. We are seeing more and more corporates now pledging around 2050 carbon neutrality, and that is a reality when we are discussing with all those clients. So that's exactly why we are seeing now a lot of innovations coming into this energy transition trend. If we're going to the second slide, which is more about a snapshot on, let's say, the key themes where we see a number of investments to be made going forward. First, obviously, is mainstream. That's renewable energy, which is expected to massively grow. We're expecting 3 to 4 times the current deployment rate of solar and wind globally to reach the level of renewable energy deployment anticipated by 2050. One of the big issues is that for large utility scale projects, we are already seeing limitations on available space for onshore deployment, which are pushing new boundaries into large offshore wind farms and or floating solar farms. On top, we're seeing major developments that are being made on renewable decentralized generations. Obviously, you are all seeing these developments on, let's say, electrification and parkings on buildings, micro and mini grids developments for consumers and industrial applications. The other point is that renewable energy is coming with intermittency, and in practice, that is requiring massive investments in battery storage for the grid balancing. It is requiring as well interconnectors to manage excess deficit of green electricity generation at any point in time in different geographies. So we see here a very strong potential from an investment standpoint to invest in those thematics. Can be obviously with the large utilities, oil and gas players, and financial sponsors that are very active on that front. But on top of that, there is a lot of independent companies that are developing their own projects and building up powerful platforms over time. Now, if we're focusing on a second value chain, I would call it, which is about electromobility, here again, it is a topic which is really expanding, and it is expanding now. It is really accelerating, and that's coming from two main elements. One is about regulations, basically, and the other one is about civil society that is really pushing to go into this direction ahead even of political, let's say, decisions that are being taking place. So a consensus is now reached on the EV cars deployment. We're talking about 58% by 2040, which in practice will require huge additional capacity in terms of battery and related infrastructure. Here we are talking about EV recharging infrastructure. It is as well requiring additional mining resources. And in particular, we're talking about lithium, we're talking about nickel, about cobalt. And on top of that, if we look at the whole value chain to build, let's say, cars, trucks, and buses, what is important to understand is that all those O&Ms needs to enter into green steel production so that they can have access to this steel that is necessary for all these cars, but which is becoming green in terms of production. And that's very important to have that in mind. On top, battery recycling, which is a bit a question for tomorrow, is already something that is being discussed by all gigafactories developers. So this whole value chain is currently requiring multiple industrial partnerships, innovation and financial support from public and private sources, and we see a clear acceleration on that trend. Now, if we focus on hydrogen, that people are talking a lot about these latest months, and I would say now more than 2 years. And if we're looking in more particularly on green hydrogen, what we think on our side is that it is expected to play a central role in hard to abate sectors in terms of GHG emissions, like the steel industry, the cement industry, refineries, chemistry, and in some applications to mobility. We're talking about shipping, airlines, and long-haul heavy trucks. But it remains a nascent market at this stage. So this technology, once again, is clearly supported by public and private joint initiatives to deploy at scale and over time with affordable costs. We see the emergence clearly, and I think it's really a key trend that we can as well comment on the electromobility side, the emergence of a new ecosystem with multiple partnerships between industrial companies to mutualize costs, to accelerate innovation, and to accelerate demand. The reason for that is that there is a big thing at stake. We're talking about 6 gigatons of CO2 avoidance potential by 2050, looking at hydrogen decarbonization way. 45 million jobs to be created by 2050, globally speaking. So that's the reason why we see so many projects across the board. There are more than 230 that have been announced for $350 billion already, most in Europe, US, Asia, and Middle East. So that's where we stand on H2, which is really a key thematics for additional investments to be made and very interesting for any type of investors. Now, just a quick snapshot on energy efficiency, which is today, as I said initially, a very important part of the equation. But on the other front, what we see that it is mostly financed today by free cash flow generation generated by companies. It's becoming much more challenging to finance it from a third-party point of view. The reason for that is that in general, these investments are individually small scale. So we're talking about lighting replacement by LED, or new heating pumps, new cooling systems. And then the financing business model is different from all other traditional business models, as they are not generating revenues, but they're reducing energy spending. So the challenge here for the financiers is to find ways to aggregate such small scale assets to ease a massive deployment. So just in a nutshell, globally, we see investors really willing to accompany the development of energy transition, which is just where the CapEx are going for the decades to come, in particular for mature technologies and in developed countries. It becomes more challenging for small scale assets and or in emerging countries. And I will leave the floor to hear more about the state of the art on these topics to Marie-Aimée Goury.
Thank you, Eric. So indeed, I would like to take a step back and look at where is the bulk of the SDG investment needs. And as you can see on this page, there are huge needs globally. And when we look at the gap of investments, the estimate is that there's about 2.6 trillion investments that should be made in order to achieve the SDGs by 2030, but are not made. And if we narrow down, it's not very surprising to see that in developed countries, which are most of the areas where the large investments that Eric has just listed are taking place, the gap is not very big. We have estimated that it's about 100 billion a year. And of course, the development of the financial markets in those countries, as well as the development of the economic actors able to develop and put in place those solutions quite explains the limited funding gap. If we turn of the gap, so 90% of the investment gap for the SDGs is in fact in developing countries, as you can see on this page. And if we have a focus on Africa, we can see that in Africa alone, we concentrate 50% of that investment gap. So that's, again, not very surprising, considering that there is already a lag in terms of infrastructure development in Africa, and coupled with the fact that the financial situation of the African continent does not provide them with sufficient resources to make those investments. And this, of course, is also coupled with the growing population on the continent, which, as you can see here, is going to double to reach one fourth of the global population by 2050. So the question is, how do we bridge this investment gap, and how can we access, unlock those investment opportunities in developing countries? So we've looked into this. And what we found is that the technical solutions exist to deliver solutions in developing countries. The issue is that our business models are not adapted to address those markets, and we need, in fact, to change our business models in order to address these needs in developing countries. And when we deep dive a bit more, we see, in fact, 3 key hurdles to unlock those investment opportunities in developing countries. First is the costs are too high. So the solutions provided are too expensive for the addressable market, which mostly is consisting of bottom of the pyramid customers who have purchasing power, but is not enough to afford the solution provided. So we need to work on reducing the costs. Second issue is the deals are too small. Unfortunately, most of the investments needed are small-scale dispersed assets, and they do not come in nice, handy 1 billion infrastructure project, which investment bankers are very keen and able to finance. So how do we go about financing, thousands, millions of investments of $100,000, $1 million in very remote places in very widespread countries? And the third issue is risk misperception. More often than not, there is this perception that investments in developing countries are going to be very risky, and that only with certain traditional financing structures we can have a proper mitigation of risks. So our approach has been that to solve those problems, we should focus on the impacts and see how we can use the impacts, so the bringing out more positive impacts out of the investments in order to increase the revenues, increase the resilience, and reduce the risk of those opportunities. So for example, on the costs, the idea here is to see how we can combine services for any given infrastructure or other type of investments, to see how we can address more needs, which will potentially generate more revenues, or at least increase the outcome for the population targeted of those investments, and as a whole bring down the cost to impact. The second way impact is a solution in those issues is by looking at standardizing and simplifying the solutions in order to be able to replicate them more easily and more rapidly. So here again, having more standardized and multi-impact services, we can do a better job in the scaling up of those solutions, and then of course reach critical size transactions that are more easily financed by the investing community, whether it's banks or private or public investors. And last, on the risk part, of course, the standardization and simplification aggregation will increase, of course, the appetite from investors, as it will bring intrinsic diversification. Of course, financing a portfolio is less risky than financing a deal by deal. But here, what we can really improve much further is the way we credit enhance those transactions. So using more blended finance techniques, which means using catalytic capital in the form of public funding or philanthropic money, that instead of being spent in subsidies or donations, should be used as first losses or guarantees in order to bring in more private investors in those areas where they have less experience or where they are more cautious in terms of risks. And the second very important aspect of credit enhancement is also to exploit as much as possible the data available in order to deconstruct those risk misperception and prove that we can have profitable businesses in developing countries, showing by evidencing the data that will prove not only a payment track record, but also the impact performance of those investments. And through those different improvements, we really see digitalization as an impact enabler, as a tool that will allow to bring down costs, to standardize and aggregate transactions, and also to bring more transparency on the risks and on the access to the opportunities. So that's what we're working on with our clients, using, of course, the different financing solutions that the bank has, and also, of course, tapping also on the appetite that investor community is increasingly showing for impact investments. Then maybe quickly, in the interest of time, going through an example of how to implement this impact-based finance approach. So, for example, in the space of access to electricity, as you may know, there are more than 800 million people globally who do not have access to electricity, and close to 1.5 billion people who have unreliable access to electricity. So it's a huge issue. And of course, access to electricity is a huge enabler for economic development and an improvement of many different aspects of life. In a traditional, I would say, business model, a power developer will come to install a mini grid and will face very large difficulties for the financing of those mini grids in, for example, rural areas in Africa, because the population, the communities that are going to be buying this electricity have a very little economic development, and payment, the risk is perceived to be very high, and therefore the repayment period for this investment is going to be quite long, and overall the investment is going to be perceived as quite risky. If we look at what are the other needs of the targeted community and how we can augment the impact of the project, for example, by combining services and finding a telecom operator or other company bringing connectivity in addition to the power project, we can then unlock many more additional services that might also generate additional revenues. They could be opportunities to mutualize the costs of the logistic costs at implementation of those projects, but also the maintenance costs throughout the life of those projects. And therefore, we have more diversified cash flows, more resilient projects that addresses more needs of the community, and therefore a higher probability that the demand will grow and the payments will be secured for that initial project. So overall, the multiplication of impacts, addressing more needs and combining services through partnerships between different operators is improving the bankability of the project. So maybe in conclusion, on that last page here, I would like to leave you with a message of disruption. I think it's important to realize that it's good to apply ESG screening. It's good to to be focusing investments on companies that are using best practice. But if we really want to achieve the SDGs and address that absolutely huge gap of investments in developing countries, it's essential that every actor of the value chains focus their business models and think about how to provide positive impacts as a core at the core of their businesses. And on the investor side, it's very important that every investor class pushes the boundaries in order to venture into new areas, and of course with the support of adequate credit enhancement solutions from the public sector to enter those markets. So that's definitely something we're working on, and that we're very keen to channel to the investment in terms of investment. Back to you, Petra.
Yes, thank you very much, Marie-Aimée and Eric. And before coming to the questions, we will finish with the quotation of Charles Darwin. They've seen that we are needing this energy transition, so we need to change. And he already said in 1809 that it is not the strongest of the species that survives, nor the most intelligent, but the one most responsive to change. So we need to change, we need the disruption, and hopefully we will be capable to reach it. Let's go to the questions. So don't hesitate to write it in the chat you have on your right side. We're having already the first question. Blended finance seems a very good solution to deal with the risk misperception challenge, but it seems that the take-up of blended finance is low. How can blended finance be made more attractive to private capital, more investors and more capital invested? Marie-Aimée, maybe, or?
Yes, no, indeed, it's very slow. And I think one of the issue is that, you know, as you just said, we need to change. And typically the institutions that are providing catalytic capital to projects are typically, you know, development finance institutions, multilaterals, or foundations, which have a very, I'm going to say, not very nimble processes. And so, you know, the time between the moment where you're presenting an opportunity and it's been analyzed and assessed and you know, a proposal is made and then put into place is too long, in fact. So it's not the lack of you know, of money available from catalytic capital providers, but it's more the processes that I believe need to be very significantly streamlined and accelerated. And us bankers as well, we need to do a better job as well in you know, everything that comes from you know, due diligence processes, credit approval processes, as well as legal documentation negotiation. If everyone has in mind this goal and you know, the huge challenge we have in terms of the size of the investments that need to be made, it should help us make the effort to simplify and standardize the different elements of our processes in order to streamline it. And that's the way where we're going to, I think, be more efficient at using a blended finance solution.
Thank you, Marie-Aimée. I think I have a question for Eric. Regarding the energy transition, what are the aspects that will be the hardest technically to achieve?
I think the question is about twofold in practice. There is technical issues on a number of situations, new processes and new developments to come. And to be honest, when we are discussing with some of the big players around their decarbonization roadmap, what they've mentioned is that they have probably a solution for something around 60 to 70% of their decarbonization roadmap, but there remain 30–40% still to be created through innovation. So that's one thing. The other point is that you can technically do a lot of things in practice, and there are a lot of solutions available already. The question is more about the commercial viability of those new business models. And that's one of the key topics and one of the key issues we're facing. So the good point here is that governments are really supporting a number of initiatives in terms of R&D, the EIB as well, the European Union. In the US, that's more about tax aspects that are putting in place to create innovation. And what we're seeing as well, and I think it's unprecedented, it's a multiplication of partnerships between different industrials to put in place the right solutions from a technical standpoint that will work for the industry as a whole. So we see more collaboration on that front than purely competition, and I think it's a good way to expand and to deploy it at the right pace. And technically speaking, obviously, everything could be feasible, but the cost is really the big issue. So I would not comment more on technical, but more on the fact that we need to enter into large-scale deployment, and that's the case, for example, for green hydrogen that we were discussing about. It's available to some extent, but it's a question of cost. And then large-scale deployment can definitely reduce cost and be more competitive. Create carbon storage and utilization. There are some technical issues, but to some extent, we have a number of capacities to make it. The point is about the cost to implement such type of solutions as well, and to create business models that are not generating only cost savings or cost at all, but revenues or new revenues generating by this storage and utilization of CO2. So I think, I mean, in a nutshell, that's probably the best answer to this question.
Thank you, Rick. And we have another question on investing in Africa. Do you see recent increased interest in investing in Africa? Isn't one of the challenges that there are 54 countries on the continent and some corruption challenges in some countries can scare away the investors?
That's a good point.
I think Marie-Aimée the best
Yes,
to
I mean, Eric could talk about that
answer.
as well, but I'll give it a go, and maybe Eric can chime in as well. So yes, there is interest, increased interest in investing in Africa, but of course the situation, the financial situation in many countries has been very, was fragile in the first place, but is even more fragile now, as a result of the pandemic, since many of their of the activities that are reliant of tourism, for example, have been challenged by the strong reduction in tourism as a result of the pandemic, and also those countries, for many of them, rely on exports of oil or other commodities for most of their revenues, and we are, as Eric explained very well, in the process of decarbonization. So there is a need to replace those revenue flows by local development and other industries. I don't see the fact that there are 55 countries as a challenge, but more as an opportunity. It's often it's a very frequent mistake to think about Africa as a country. It's a continent, and in the same way that in Europe you have many different countries with different risk profile, even though we have the same currency. There are different situations, and indeed corruption is an issue in many of those countries. But here, what I would say is that the evolution is really on the right track. And another point which is very interesting is how digitalization is bringing more transparency, and the fact that we can track everything digitally, on any given project that is financed, or the payment flows, etc. And the fact as well that certain countries themselves take initiatives to increase the use of digital tools to pay for certain services or in their administration, is ongoing, I believe, to improve significantly the situation. So overall, of course, some countries are better than others in terms of investment climates, and that's the one we should focus on. And they are generally seen as models by other countries, and we see a good trend, I would say, in terms of improving the governance and looking to propose projects that are in line with investors' expectations.
If I can just complement a bit on few things, I'm a big fan of Africa, like Marie-Aimée, so we like to talk about these countries. And to be honest, we've made billions of dollars of transactions in Africa. So it's not, let's say, continent, neither countries that are really we cannot work with. The point is that there is large diversity of countries, as Marie-Aimée mentioned. There are regulations that needs to be implemented in those countries so that those, let's say, developments, I will talk about energy transition here, can be implemented in a relatively safe way, meaning that there is predictability of cash flows to be generated by those, let's say, new projects to be developed, and that investors are not in a situation where from day one to day two, regulations is moving. And I think the key point here is this one. And to some extent, energy transition is a very big challenge for African countries, and in particular for the one producing oil and gas, historically speaking. But the reality is that we're talking about as well smaller scale financing. So probably we need to find some ways to aggregate things, but it is a bit easier to develop, to deploy in some remote situation with rural populations and so on and so forth. So it's probably the moment to expand businesses in Africa, but African countries need, for a number of them, a lot of support, technical support, to put in place the right, let's say, regulation and have enough political stability shown to the investor, that investors can really enter into these markets big time, that bigger than what they did in the past. But I think really we're on the good shape on that front, because we see a number of investors and key players, including oil and gas players to some extent, willing to accompany those clients and willing to accompany the energy transition of those countries in developing on their side, let's say, renewables and others type of mobilities, which are part of their new business models going forward. So I'm quite positive on that front personally.
Okay, thank you. And I will take the last question. Do you see increasing cooperation at the international or supranational level for investment in energy projects? Is the climate crisis increasing this cooperation?
It's a huge question. I can give it a quick try, but maybe Eric has also a lot to say on that. Yes, we see a lot of discussions and you know, coalitions and global initiatives. At the policy level, at the government level, I'm not sure it's still very concrete, but there's definitely a lot of initiatives, private initiatives taken by companies or investors or banks to collaborate and converge on the way they're doing things. So, for example, in the banking sector, we've teamed up with other banks in order to design a framework to adapt our activity to a 1.5 degree scenario, instead of doing this each in our own institutions and come up with 4 different frameworks, for example. So, of course, you know about the COP, the UN convened global discussions, and they will result necessarily into some hopefully global frameworks to invest. But at the end of the day, the businesses must be developed by companies, and although regulation is very important to set a predictable and safe place for corporates to invest, I think it's as important to have companies cooperate together to see how they can make those investments and address those markets in a profitable way. Maybe Eric, you have other views on that?
Yeah, no, I think no, I'm fully aligned with what you are saying. But I think what we see as well is really a sort of, if we take the example of hydrogen, which is to some extent where we could say, okay, hydrogen is good for a number of developed countries, but to what extent is it applicable to countries like Africa? But Africa is a key area of development of a number of those big guys that are developing those technologies to be applicable to a number of let's say applications like mobility ones for heavy trucks that you are using in the mining sectors in some remote positions, and I could mention a number of other situations. So the good thing is that on one side you have much more cooperation between industrial companies to provide and look at how to reduce costs for those new technologies. On the other front, there is a focus, but it's in let's say a competition way. There is a focus on Africa, and I would say that it's developing business there. International or supranational, let's say, institutions are willing to play a role. Commercial banks are willing to play a role. So I think there is a sort of good momentum to make it. Now, there are, as we said, other topics really about regulation, about training, we see as well on people locally. And I think there are very good new programs of developing talent and developing, let's say, skill set of local population using international companies, and we are part of one of those initiatives with one investment fund on the other front. And I think that everything on that kind is going to, let's say, more development, more international, let's say, cooperation, and that's really the way to make it. So once again, we see a bit more cooperation than in the past, probably not enough, having said, nevertheless.
Thank you, Eric. Thank you, Marie-Aimée. So with this last question, I would like to thank you one more time for the connection to our session. And I'm wishing you a nice day and passing the final conclusion words to Denise.
Thank you, Petra. And thank you, Eric. Thank you, Marie-Aimée. That was really fascinating. And I learned a lot. And I think the energy transition obviously is such an important topic. But also, on the other hand, basically Africa and investing in Africa is another very important topic that we don't necessarily hear enough about, actually. So thank you very much. And thanks for making yourselves available for this. So again, I'd like to thank Société Générale and Société Générale Private Banking in particular for hosting the session. And I'd like to end the session with a quote that I hope will resonate with you. We now understand that sustainable finance is not just another type of investment, it's a complete shift of mindset. And I think we talked about that a little bit today. We had examples of that today. So thank you again. So our next session will start at 2. It's hosted by GSK Stockman and focuses on ESG challenges for your investment process. Thanks again, all, and have a great day.
Thank you very much.
Thank you very much.
Thanks. Bye-bye.
Bye.
Thanks, bye.